And what it do, world? Welcome to the Market Banter podcast. We are on video for the first time. Hopefully, this goes well. Dan is smiling, looking really happy. Now people can see
Yeah,
us.
exactly.
This is
Yeah,
an exciting
it's
development.
think about where we started in a coffee shop, couldn't get the audio going months ago, and now we got the video rocking.
Now we got the hopefully. I mean, provided everything doesn't go horribly
Hopefully,
wrong. Yeah, you're
right.
you're a little bit in the dark now. When you were in the light before, what happened? Why did you?
I don't know. I did not move anything, but I can keep it like this if you want, or I can keep this above here.
This isn't going to make any sense to anybody who's listening on the podcast. Dan picked up a lamp and just put it across the screen. Yeah, hopefully everyone's listening to
that better
with video. No, it's the same, but it's fine. Whatever.
Yeah.
How's it going, Dan? How are you?
Okay.
How's the BX?
Everyone's great, man. Bronx is still alive. Don't listen to the naysayers.
Don't listen to them.
Listen.
That's good. We have a packed, fantastic, outstanding show. I'm really excited about it. Dan's here. I'm here. Of course, you're here listening to us on Market Banter, which, I think we can definitively say is the best financial podcast in the world at this point. There are no competitors.
Second to none. Absolutely.
Market Banter cannot be duplicated or imitated. It can only be, I was going to say replicated, but that doesn't work out. Anyway, we also have,
this isn't like, DoorDash, Grubhub, Uber Eats, all three are the same thing.
No,
there's only one.
No. There's only one Market Banter, and we have Jurrien Timmer. He is the director of global macro at Fidelity. He's on the show with us. That's right. The director of global macro at Fidelity is going to be talking to us. We're getting to him in just a few minutes.
I wish this guy's title was bigger,
Yeah, director of global macro. Yeah, that guy. He's got a $10,000 bike. So that should tell you a little bit about the guy we're interviewing on the Market Banter podcast today.
It's not a Schwinn, is what you're saying. It's not a Schwinn.
It might be. Schwinn makes some really expensive bikes.
Oh, they do?
Actually, yeah. Schwinn makes expensive bikes. I think I've seen some pretty good Schwinns out there.
Oh wow.
I am not a bicycle aficionado myself. My bike cost $100 and I bought it at Walmart. But people who are bicycle aficionados, I think, ride Schwinn bikes. So I don't want to put Schwinn down.
So never mind then. Pardon me.
Yeah. Maybe they might sponsor the show. So like, don't dish Schwinn. Show love to Schwinn.
Okay.
Anyway, before we get into that, we are going to get into a little game of buy or sell. We talk about whether we would buy or sell these things and why. And then, like I said, we'll have Jurrien Timmer, and then we're going to talk a little bit about the Fed, a little bit about the current state of the markets. My new phrase is BTF ATH. Used to be BTFD, buy the effing dip. We're switching that now. That's over. It's BTF ATH, buy the effing all-time high, which means even though stocks are at all-time highs, you still buy. Still buy. With that in mind, let's get into a little bit of buy or sell other than the stock market. Dan, what's your first item on buy or sell?
I have Slack here.
Slack. Okay.
Good old Slack.
So Slack was just bought.
Yes.
So is your question whether I would buy it from Salesforce that has purchased it for
just in general? Yeah. Like, would you ever buy it? Buy it?
Like, would I go to Salesforce and be like, okay, I'll give you $30 billion for Slack if I had $30 billion? And I think the answer to that is yes. I would buy it. And here's why. We've proven that profit doesn't matter and that the actual pieces of a business, like the way it organizes itself and generates money and then uses that money to actually turn a profit or not, is irrelevant to the value of the business, aka its stock price. Ergo, if you can just get a bunch of people on Slack, which people are on Slack, like Slack is the verb, right? Like you don't say, I'm going to Microsoft Teams you, or I'm going to,
right.
or I'm going to Skype message you. You say I'm in
Right.
Slack. You're like, oh yeah, and then people are getting on Slack groups. Like this email group that I've been on for more than a decade now just sent out this thing saying like, yeah, the listserv is going down. We're all moving to Slack. And I just think it's become such a part of our culture. It's not going to go anywhere, which means that I could grow the business, which means that some greater fool will pay me $35 billion for it in a year or two. Ergo,
Right.
it's a good investment. So I say buy.
Okay. Okay, great.
What do you say?
In the same vein of like Zoom, I'm going to say sell. I can't, I mean, maybe I'm at a disadvantage because my company doesn't use Slack. I've never personally used it. I've heard about it, but like, to me, it seems that like GChat or whatever other, chat bot that you use could do
Yeah.
Slack does like tomorrow. They just don't seem to have the capability or care to develop it.
Does your team use Microsoft Teams or something like that? Or do you
No,
just
we don't
not?
use anything. I work,
Okay.
we don't use anything. We use, I guess like GChat, but I think we're still very much email based.
Like you call each other on the phone, or you?
Yeah, exactly right. Yeah. No, we only fax each other.
Yeah. I've been looking into some real estate, and this agent that I was talking to was like, yeah, fax me information. I was like, sorry, what? You want me to do what?
Fax you what? Yeah.
Fax you my what? Like I just have a fax machine.
In fairness, he just paid you with his fax number, right?
Yeah. Check it. Oh, okay, gotcha.
Oh,
Yeah, I'll hit you with the fax.
There you go.
All right. So my first buy or sell is movie theaters. Dan, what do you think? The movies, are you buying or selling?
You know what? I love going to the theater, and I listened to this interview with Quentin Tarantino recently about how he's a purist, and if you really want to enjoy cinema, you got to enjoy it in the theater. I know whenever I try to watch movies at home, you got the kid running around, your phone's going. Obviously, you make do in the times that you have to make do in, but I just feel like I enjoy going to the movies. And in that same vein, I was reading an interview with a guy who started a competitor to Amazon. I think it's called like books.com or something. Or I think it's called Bookshop. And he said as to why, they actually have physical bookstores. He's like, people need something to do. And I think that's in the same vein of movie theaters. Like, sometimes you got time on your hands. Hey, I'm going to go to the theater and, watch a film, It can't be work from home all the time, I guess, so.
I hear you. I am selling movie theaters.
Ooh.
I'm selling, and here's why. So basically I don't know if you've heard about this, but basically like Wonder Woman, 1984, all these huge new movies are coming directly to HBO Max.
I did hear about that. Yes.
Yeah. There's this whole big thing, right? Like all of these movies from Warner Brothers, all their superhero, they're big blockbusters. They basically said like, okay, we're going to put them out in theaters, but we're also going to put them all on HBO Max. I'm really excited because I have HBO Max, and it's not unlike Disney Plus with Mulan. They're not going to try to charge you $30 for it. And I should say first, I'm a movie theater hater for years. Like I decided to stop going to movie theaters when I was 14 years old. I was like, the value proposition is just not there for me to pay $15. I think I don't know what it is now, like $18, $19, $20, whatever it costs now, an individual ticket, right? If you're in New York City, you got to find parking. You've got to pay for that parking. If you want snacks, like you're talking about $150 all in
easy
for like
easy.
2 people. If you got a family, even more than that. And now that this other option's presented itself, I just don't think they can take it back. So I think movie theater is over. No more movie theaters. That's done.
Wow.
All right. Last but not least, we're going to do Zoom. That's the company. We've talked about it a lot on this show. Dan, I think most people, any of our listeners know where you stand on Zoom.
Oh, God.
But yeah, I will also sell Zoom. I'll sell Zoom. I would be a buyer of Slack and a seller of Zoom. For this reason, I don't think it's that difficult to replicate. And I don't think that even though we're recording this meeting on Zoom, and Zoom, as you know, monitors meetings, they're probably going to shut this down. We're probably going to be banned from using Zoom for
and
both
like
being
Zoom
sellers.
corporate, there's like a red button going off right now, like alert.
Yeah. People are talking bad about Zoom. Cut off their meeting. That's the other thing. Like, they got in trouble for working with the Chinese government to stop people saying bad things about China over Zoom. So I think it's not a difficult model to replicate. I think the people who, were going to be like, oh, I don't like Zoom, have other options. I think Microsoft is going to create a version for companies that makes them want to leave Zoom, or,
right.
Some other company. And I don't see the long-term, like, I don't think it's embedded itself the way Slack has to be able to fetch that greater fool down the road. That's my argument against Zoom, even though it's kind of the same thing as Slack, except I think Slack has embedded itself in a way that Zoom has not.
I agree with that. I'm going to agree with that for sure.
Okay. So you are also a seller?
Sell the whole damn thing.
To the surprise of no one. The surprise of no one. Which, by the way, we should point out, like, I might have been a buyer of Zoom when it was up like 10 or 20%. It's Zoom at 400% gain that I am a seller of. Slack's valuation also hasn't gone sky high the way Zoom's has, which another interesting thing. They also haven't made anywhere near as much money.
Yeah.
Anyway, that is our buy versus sell. We are going to go right now to our interview with Jurrien. And this one was a great interview. I spent a lot of the time playing kind of devil's advocate for this new BTF ATH philosophy. And Jurrien very smartly and steadily made the case for diversification and all these old school things that the old heads are doing. But right now we've got our interview with Jurrien Timmer, Director of Global Macro at Fidelity. Why not just go all FANG stocks at this point, or all FANG plus growth stocks? Like, why not just your portfolio is Airbnb, DoorDash, Facebook, Netflix, Google, like no bonds, no hedging, because the Fed is your hedge, right? The Fed's not going to let stocks go down too much without stepping into the market and, getting it back on track. So why bother with things like the 60-40 portfolio or downside protection or things like that? Like, why not just go all growth stocks at this point?
Well, look, it's a fair question. It's not where I'm at or what I would advocate. It's certainly true that growth stocks have worked like nothing else over the past 10, 11 years. And they worked, during the depths of the COVID crash back in March. Certainly value didn't help you at that time. So yeah, it's easy to say, just do all growth. And
yes.
In a way, it depends on what your age is and what your demographic is, right? If you're 25 and you're starting off your career and you're maxing out your 401k, you're not going to need that money for 40 years. Certainly a more risk-oriented profile makes sense, as opposed to if you're 60 and you're retiring in 5 years and you're going to need to draw on some income. You don't want to be all in the growthiest part, which is also the most expensive part of the market. Somewhat,
it is. But this is the traditional way of looking at things. And I understand, young people, you can take more risk. I'm saying, hasn't the Fed eliminated risk such that even old people at 65, and I don't mean to, disrespect our elderly seniors out there, I got love for them, but even folks nearing retirement should just be all in growth stocks. They can get the most out of their retirement because we're in a new era where the Fed has your back.
I think that the Fed does have our back, but the Fed cannot do it alone. And so I think the way I think of what's happened over the past 9 or 10 months is that, we had the COVID crash basically in March. We had the combined fiscal monetary policy response. I call it a fiscal monetary cocktail. We haven't seen that cocktail very often in the history of this country. You have to go back to the 1940s when the U.S. was joining World War II to get that. But Jay Powell of the Fed has said many times we can't do this alone. When rates are at zero and the Fed's already expanding the balance sheet and they've added $3 trillion to it since March, there's a limit to what they can do. Yes, they can keep rates at zero. And if
wait, but is there?
What's that?
Is there a limit? Because he says that, and then he goes out and launches QE Infinity, right? And so now we've got QE Infinity. We know that the Fed can buy corporate bonds. I mean, there's no one, I don't think, who, and correct me if I'm wrong, doubts that if things get really bad, they'll step in, they'll buy stocks. They've already bought junk bonds, so they can do that. I think that the Fed says they need fiscal stimulus, and it was Mario Draghi was saying this back in 2012. Mm-hmm. So clearly there's more that they can do. They've shown that they will not hesitate to just step all over the Federal Reserve Act and do whatever it takes to keep stock prices high, even if, as we've seen, it doesn't necessarily help the real economy. So I like I said, I'm trying to see, I'm playing devil's advocate a little bit here, but this is a real question for someone who's a serious guy like yourself and who advises over these portfolios. Aren't we at a place where things are just changing now, where you have to say, hey, you know what? Why not be all in growth stocks?
Yeah, I disagree on that front. I do think that the Fed, it hasn't run out of ammo, and Jay Powell has made that very, very clear over the recent months. But I think when growth is slow and demographically, we have a very low speed limit for the economy because the growth in the labor force has been declining for years, not just in the US, but in Japan, Europe, China. And that limits how much you can grow. And at the same time, debt to GDP is already well north of 100% and growing pretty rapidly. So you're limited in what you can do. Yeah, you can push rates down to zero, maybe even negative, although I think the experiments over in Europe and Japan show that really has not worked at all. You can keep expanding the balance sheet. And remember, back in the 40s, the Fed increased its balance sheet tenfold. I mean, the Fed's only done 50%, at this point. Tenfold is 1,000%. So there's certainly more that the Fed can do. If the Fed wanted to buy equities like the Bank of Japan has done for years now, it would require a congressional act. But again, if we get this coordination between fiscal and monetary, which I do think is what is needed, and Japan has sort of gone there already before us.
Right.
And I think it's interesting that, with the recent appointment of Janet Yellen at the Treasury, person, I do think we will see that coordination. I think it will fall shy of, MMT and, that whole concept. But I do think you need it because remember what happened after the financial crisis. The Fed printed the same amount of money that it did so far now, $3 trillion, although it did it over a much slower period of time.
Yeah, it did it over years.
At that point, we also had the Tea Party movement that caused fiscal austerity. The deficit in 2009 was like 10% of GDP. In 16 or 15 or 14, it was down to 3 or 4%. So what the Fed was giving with one hand, kind of the fiscal side was taking away with the other. And the reserves that the Fed created through its QE were basically just sitting idle on bank balance sheets. And this is where one of the limitations of even what the Fed is doing in all the capacity that it's doing it doesn't go directly into the economy. When the Fed prints money, they become reserves that sit on bank balance sheets, but those banks then have to be willing to lend those reserves out into the economy. And certainly the last time they weren't, because we were just coming out of the financial crisis.
Right.
But the fiscal bridge bypasses that, because if you give people a $1,200 check, that is directly into the pocket of the consumer, and you don't have to worry about the Fed's QE getting disintermediated or intermediated by the bank. So this is why when you have a lot of debt and you have slow growth and you already have zero interest rates, you really are running out of weapons or out of ammo, and you do need that fiscal linkage to kind of make that picture more complete.
Wow.
Dan, you look like you want to ask a question.
I'm just taking it all in. So I guess Back to the DoorDash example, though, what I can't understand is if indeed a company is losing that much money, like I think you said they lost what $150 million last year, right?
Over the first 3 quarters of this year.
3 quarters of this year, excuse me. Is the IPO, is the valuation so high because of what they think it'll do in the future? Or because to me, it's like, why would anybody invest in a company that loses that much money, I guess?
Yeah, I mean, I think part of the story, and of course, these are fresh IPOs, so they have not necessarily been available to purchase before now. But part of it is the momentum play. The kind of the retail day trader jumping on that moves. So there is certainly a speculative element to this. I mean, a company is only worth so much, but I think it's the promise of what we call secular growth, long-term growth. In a world that doesn't have a lot of growth and doesn't have a lot of places where you can put your money and earn kind of a stable income. The bond market is certainly not doing that. The only reason to own bonds these days, in my opinion, is for diversification, as an insurance policy. But even as you get towards zero, I mean, the 10-year treasury is around 0.9 or so. Even then, you start losing that diversification effect because 0.9 to 0 is not as much runway as 5 to 1, for instance. So it's the promise of structural long-term growth, disruptors, again, the FANG stocks.
Right. So are you saying that, if I'm hearing you correctly, are you saying that these stocks are becoming popular because people have no other choice, basically? Like there's nothing else left?
I think a lot of actions are done out of necessity. Again, think of the demographics, not so much your cohort, but the demographics of people who are trying to save for retirement that don't have a huge time window left to do so.
Right.
In the old days, you could buy bonds earning 5%, and that was pretty good. Now you buy bonds, you get maybe 1.5%.
Yeah.
It forces you out the risk curve. And of course, the Fed's QE is part of that, right? I mean, that's the portfolio channel theory where the Fed forces you out of the risk-free asset into riskier assets. So you buy, dividend yielding stocks, which are, in my opinion, very good, but you're still buying stocks as opposed to bonds at that point.
Yeah,
So,
but you're making my point here, and I'm trying to get you to argue the opposite point, and you're just making the point, like, shouldn't those people just be in growth stocks? Like, put them 100% in the tech, put them in QQQ. 100%, no bonds, no alternatives, none of that, all QQQ, 100%, and you'll get what you need for retirement because the Fed is here. You got Jelly at the Treasury Secretary Jelly, who no question she's going to give the Fed that 13.3 authorization if things get bad again. You got JP Money churning out the money printer in case things ever get bad. So if things get bad, I feel like you want to own stocks rather than bonds, even in that case.
But at what price, right? If
at any price.
Well, see that's where we do because the starting point, your starting valuation, has a huge impact on the hurdle towards getting to the outcome. And tech large cap growth has worked as a one-way street for 11 years. I don't want to bet against them. I can tell you, like in my personal portfolio, I have what I call a barbell. I don't want to be short those big names because they generate tons of free cash flow, right? And that free cash flow is more cash flow than those companies are able to spend, even after R&D, after capital spending, after dividends, if they pay a dividend. So what do they do with all that extra cash, hundreds and hundreds of billions of dollars? Is they use part of it at least to buy back shares, which is not a direct return of shareholder value to shareholders, but it's an indirect return. And
doesn't that only benefit the executives of the company though?
No, if you own the stock,
I'm sure it benefits.
If you own the stock, it goes up. Okay.
But so think of it this way, right? I'm a big fan. I'm kind of a nerd. I'm a fan of what we call the discounted cash flow model. Right? That's a good way to value or to determine what the proper value is for the stock market. Because often if we just look at a PE, that can be very misleading. Back in April, the PE was sky high, but that's just because price tends to bottom before earnings. So at these inflection points, the PE ratio is all over the map. But the DCF, you put in a 5-year arc of earnings growth expectations. you look at the discount rate, the interest rate with which you
Right.
discount those cash flows. And then very importantly, you look at what we call the payout ratio. How much of the earnings that companies generate do you get back? Do you get paid back to you as a shareholder? And then
And this is all in equities. You're
part
talking
of that
about,
is
right?
dividends. Yeah, it's all equity. Part of that's dividend, and part of that is buybacks. Again, buybacks is not a direct return, but it's an indirect return because the trading float gets reduced, and so the value of the stock goes up. The difference between the valuation in the US, which is more growthy, and for instance, Europe and Japan, which is more old economy, is that the payout ratio there is like 50, 60%. Here it's 90%. This is why the U.S. trades at a premium to other countries.
Right.
So this is the value proposition of these large cap growth stocks. It's not just tech; it's in healthcare, consumer.
Yeah.
You know, Amazon is kind of a consumer stock now.
Okay, you're making my argument, man. All
Okay,
QQQ.
Okay, but let me get to the punchline.
Okay. All right.
But the caveat is that if you put that in and you compare the value, which is high, and you compare it to that basket of stocks trading at 15 times earnings or 40 times earnings, it's a much harder hurdle to get across, and that's called what we call the CAPE model. The cyclical. I don't mean to throw all these acronyms at you, but the cyclically adjusted PE model says that the 10-year PE today is very accurate in predicting the 10-year forward return 10 years from now, and right now the PE is high, and so again, it's a great story. Why would you not want to own Google or Amazon or Facebook?
Yes.
But you're paying a very high price for it, and that's why I like to be diversified. To me, the other side of the barbell is actually emerging market equities. They're trading at a 14 PE,
EM2.
Whereas the S&P is trading at a 22 PE, and I think the dollar is going to continue to come down. So I want to have that cyclical value exposure that's inversely tied to a falling dollar. So I think there's different ways to make money. And after a one-way street 11-year run, I'd rather sprinkle some assets in other places as well, because no trend lasts forever. And again, it's not just the fundamentals of the trend that you have to look at, it's the price you're paying for it. But buying DoorDash at 20 times earnings that they don't have yet, or 500
what
times
earnings
that they don't have yet, it makes a difference.
I mean, it does, but it only makes a difference if stock prices go down ever, which they won't, because the Fed is here. And if they do, it'll be temporary, and then they'll go right back up.
But remember also, price always leads earnings. It always discounts the future, right? So for instance, right now we're having a monster rally in the stock market off the March lows, and we're even up on a year-to-date basis. And this is in anticipation of the output gap, right? The hole that's in the economy because of the lockdowns and COVID, that gap will get filled. And in my estimation, probably next year it will get filled. The economy went from 100% to 20% back to 70, but it needs to go back to 100. And right now, with COVID cases rising everywhere, it's actually stalling out a bit. So the market's already betting on that 100% next year. So if we actually get to there next year, which I think we will, especially now with the vaccine news, the market may actually not do much because it's already been priced in. So
you're saying it can't go any higher, basically.
It can go higher, but certainly not to the degree that it has been over the last.
Not the ratio that it grew this past year.
Right. So remember, when you talk about all QQQ, a lot of the growth story is in the price already. If it was an undiscovered growth story, that's a different ball game. But like a DoorDash and Airbnb coming out at astronomical valuations, or Tesla, you can look at that company as well. A lot of this is in the price already. And so that's a very important part of investing, is you want to have the good stories, but you want to have them before other people know about them, because then you're getting in on the cheap. And there is no cheap in the FANG world right now.
So yeah, that was our chat. Wow. That was our chat with Jurrien Timmer. He is the global chief of macro at Fidelity, or the director of global macro, excuse me. I guess that was the same thing. I want to make sure and get that man's title right, though. Appreciate him coming on the show. Dan, what'd you make of the interview?
I feel like I should be paying him for that advice.
Yeah, what advice did you get? What did you learn?
No, just about how, I don't want to say he was skeptical, but it seems like if I understood him correctly, it's tough with a lot of these finance guys because, they bludgeon you with so many acronyms and lots of just fast moving parts and stuff. But I think if I understood him correctly, he was basically saying that like the potential gain of a lot of these FANG stocks may be kind of at its end, that like it can't really go up. I guess that can't really get it on the ground floor anymore of them. So you may want to look at other opportunities is what I thought he said. But
yeah, that was well, he was saying, and he was saying he doesn't want to bet against them, but like you wouldn't want to have a portfolio of just FANG or just these growth stock names because they've already grown so much, which, I was playing devil's advocate a bit there, but that makes a bit of sense. But honestly, I was halfway playing devil's advocate because I do think that we've reached a place where the economy just doesn't function the way it used to. And you really have to ask yourself if, that was the case before, where there was like a ceiling. And once you had grown so much, you could only really grow so much more. But I think with all the free money that's out there, all the money the Fed has pumped out in the world and the other central banks, they're just like, there kind of isn't anymore. And all those rules governing the way stocks are supposed to perform and function cease to exist. And I want to end on this note because I got into it a bit on Twitter this week with some of the I got to come up with a name for these people, but the people who defend the Fed at all costs. Like I wrote a story.
Fed apologists.
The Fed, I don't even know if they're apologists because I think they don't think the Fed has anything to apologize for. Right. Ooh. And they're offended at the idea that the Fed would have anything to apologize for. But I feel like Fed lovers, I don't know, is a bit Fed too lovers. Childish.
Like, you're a Fed lover. You're a Fed lover.
Yeah, that makes me sound like I'm 6 years old or something. But I don't know, these people, I have to come up with a catchy name for them, like the market truthers. But these people,
I love market. I think that was your best one, the market truthers.
Yeah. I pride myself on these names. But these people who think that, who don't understand why what the Fed has done could be negative, why there's a negative flip side. So on the one hand, yes, the Fed has held up the economy and kept asset prices from falling and kept markets functioning and all that. But there's a flip side to what the Fed has done. And it's what these people don't understand, because I think literally like they've never met a poor person, or they've never met someone who isn't involved in the stock market, who like doesn't have a 401k. Like I think literally they know none of these people, and they may have gone their entire lives without having met one. So I want to break it down for those people, why there is a negative to the Fed stepping in to the market and making asset prices rise unnaturally and taking over the economy. So in a normal recession, in recessions of old, you would have a situation where everything kind of was destroyed and then you had to rebuild, right? Like businesses were suffering because their consumers were suffering. And so everyone kind of had to go sort of rein in what they were doing and reevaluate their spending and reevaluate their buying and all that. What you've had now is a situation where only like half of people have to do that. And it's the poorer half of people, the people who aren't asset owners, the people who generally don't have really impressive white collar jobs, aren't in the stock market, don't own financial assets, don't own big expensive homes. Those people have to reevaluate how they're living and what they're spending money on, and have to go out and find new creative ways to reinvent themselves. People at the top, who are that other half of people, do not. And that has real consequences with something like let's say, Dan, for example, you're a comedian, right? So let's say you can't, because of the pandemic, go do comedy. Like people can't be in comedy clubs right now.
Correct.
Right? Like it's, anyone that's doing comedy, it's like Kevin Hart is inviting 50 people to his house and he's doing a comedy special for Netflix, things like that. Right. But a guy like you who does comedy at one of the various New York City comedy clubs can't do comedy. Well, that means the comedy club can't pay its rent. And in a normal recession, the landlord, the person who owns the comedy club, if the comedy club doesn't own the property itself, would say, hey, no one can pay this rent right now because we're in a recession. So I'm not going to kick you out. I'm going to work with you because you've been a good tenant. I know comedy will come back at some point.
Right.
I'm going to work with you to keep this comedy club here.
Maybe we'll get Kevin Hart to come to a show.
Yeah, maybe Kevin Hart will come to a show. Because the Fed did what it did, and these wealthy asset holders have not suffered and have not lost anything, the comedy club owner, the landlord, now has lots of people who he can sell that space to and has no real reason to try and work with the comedy club. So the comedy club gets kicked out, right?
Yes, I agree with this.
And the comedians who relied on the comedy club for income, the waitresses, all those people, they lose their spot. And now maybe Amazon puts a package center there, or maybe it gets turned into a parking lot, or, some rich turd with a bunch of money can just buy up the property because it's so cheap for him to go into the market and get free money. He buys that, what was a comedy club, and turns it into something else. And so maybe the property value accelerates because the Fed has made money cheap and the value of everything is rising, and the rich turd wins, and everyone, including the owner of the comedy club and all the comedians who relied on it, they all lose. And this is happening with mom and pop shops around the country. This is happening with, people who own restaurants, people who own basically anything that's not e-commerce right now. They are losing. And they are losing very specifically to people who have money, who can invest in property right now, because the value of that property is going to appreciate, and they can see that appreciation.
Yes.
That's what's wrong. So people who are losing are losing more, and it's creating this vicious cycle for people at the bottom end of the economic totem pole who don't have a lot of options, who didn't have a lot of options in the first place. That's why there's harm in what the Fed has done. And that's something that I don't think people understand, because they literally don't know. They don't know any comedians. They don't know any waitresses. They don't know any bartenders, except for like the bartenders and waitresses that wait on them.
People making this policy have no clue, basically.
Yeah, they have no clue because they don't know any of those people personally. They hear about it and they hear, jobs lost. Oh yeah, we're down 10 million jobs. Those people will come back, or they'll find something else to do. Or
Easy for you to say, right.
Right, exactly. And that's the point that I think gets lost in all this. Rant over. Dan, you got anything you want to rant about?
No, man, this is one of our best shows that we've ever done.
You say that all the time, but I agree with you. This is one of our best shows. And the shows just keep getting better.
They really do. I say it for the people that skip all the way to the end. That way they go back.
People who are starting on this episode of Market Banter, there's no reason to go back and listen to those old episodes. This is the best it gets right here.
That's right.
All right. Well, okay, man, I want to thank everyone that tuned in. Those of you who watched us on video, thank you so much. Those of you who listened to us on audio, now go and listen and watch the video as well. Get our numbers going up there. Dan's raising the roof. For my co-host Dan Enfield, pump it up like Joe Buttons. For my co-host Dan Enfield, I'm Dion Bowen. Thank you so much for tuning in. I want to thank our guest, Jurrien Timmer, for joining us. This has been the Market Banter podcast.
All right, man. Awesome.